Hello, everyone, and thanks for joining us for another episode of Orrick Live. This discussion is a continuing discussion of priced equity financings or preferred stock financings. They go by many names. In the first part of this episode, we talked about everything that happens for a company up until they receive a term sheet from a lead investor. So we talked about how companies usually find investors and what are the things they should be thinking about. So if you haven't reviewed that and you're interested in those topics, I suggest you start with part one of this episode. In this part, we're going to dig a little bit deeper into some key terms that go into the term sheet, and we're going to kind of unravel them and discuss the practical implications of those provisions. So joining me to do so today are two of my partners, John Bautista, who viewers of this show will have met already, and also Laura Bloxham from our Seattle office is joining us today to talk about these terms. So Laura, John, welcome. Thanks for being here.
Nice to be here.
Thanks, Aria.
Okay. So when we say preferred stock financing, price equity financing, a distinction that I draw in my mind is basically the type of stock that gets issued to investors, and that's the preferred stock versus the common stock that founders and employees and consultants have. And this preferred stock usually gets issued for cash to new investors, and if the company has some saves or convertible notes, those usually convert as well into this preferred stock. So let me start, John, with you with a very basic question, and that is, what is a preferred stock? Why is it called preferred?
Thanks, Aria. Well, it's called preferred because investors will negotiate a whole series of rights, as you point out, different than the common stock that's held by founders and employees. And these rights are set forth in the company's charter. For most companies, they're Delaware companies, and they filed a charter with the state of Delaware. And there's also rights that are set forth contractually that are negotiated between the parties. But preferred stock itself has a series of rights that are built in, associated with the shares, as documented in the charter. And those rights are superior to common stock. That's what makes preferred stock better than common stock. And those sorts of rights are liquidation preferences, dividend preferences, the right to designate board members, protective provisions or veto rights that the investors may have over certain corporate transactions, and anti-dilution protection. One thing to note is that the preferred stock is convertible into common stock, but so long as it remains preferred stock, these are the rights that attach to the preferred stock.
At a high level, the preferred stock rights that are in the charter are broken down into kind of two buckets. So the first bucket is oversight and control rights, primarily in the form of veto rights, as John mentioned, or negative control, things that the investors have a say over if the company wants to take a particular action. And then economic protections. And the economic protections in the charter largely focus on a downside scenario. If there is a sale of the company where there are insufficient proceeds to distribute to all of the holders, the preferred stockholders get special preferences in terms of those situations and certain protections in terms of those situations. So we'll walk through these in some more detail, but those are kind of the two categories of rights you can think about for the preferred stock under the charter.
Okay, sounds good. So I guess in essence, preferred stock have preferences, and those preferences are in the form of different rights and privileges. So let's get into that. Let's talk about some of these key preferences. John mentioned a few, Laura, you mentioned a few, but John, wondering if you can kind of give us a list of kind of the kind of a checklist, mental checklist that you have that we can kind of use as a roadmap for this episode.
Yeah. Well, as Laura was pointing out, besides the economic rights, which really go to the size of the round, the size of the employee stock pool, the pre-money valuation, all of these are based on the price per share, the shares outstanding that result in dilution to the founders and existing equity. The rights that get negotiated in the term sheet that attach the preferred stock are first, liquidation preference, which is what happens if the company is sold. And we'll go into more detail about that. But basically, there's two types of liquidation preferences, a non-participating preferred and a participating preferred. The right to appoint board members. Usually the preferred will have the right to appoint at least one board seat in connection with the Series A financing. The common stock would have the right to appoint the other board seats, and then there's negotiation as to what happens with the third board seat, fourth board seat, the fifth board seat. The voting rights and protective provisions that we just talked about, which are the investor veto rights. There's the anti-dilution protection. In most cases, it's what we refer to as price-based weighted average anti-dilution protection versus full ratchet protection, and we'll get into describing the differences there. Conversion rights, the right to block the conversion of preferred stock into common stock. As I mentioned earlier, preferred stock is convertible into common stock. And conversion occurs really in two instances. One is what happens on an IPO, in which case preferred converts into common. And then what happens in an acquisition? Do the investors have the right to force conversion of the preferred stock into common stock? And as I think we discussed earlier, that there are a number of contractual rights, which we will cover in the next episode because they don't attach to the stock itself. And those sorts of rights include pro rata rights, information rights, observer rights, rights of first refusal and co-sale, drag along rights, and these sorts of things that we'll get into more detail in the next episode.
Yeah, very. And I think once we have all three episodes, I suggest our viewers to kind of think about how these rights then interact with each other, because really the interesting intellectual part of the financings is how these rights really affect each other as a whole. But let's start with what I think is probably the first point and the most important part, which is the liquidation preferences. And John, I think and Laura, I want to draw a distinction again here. We talk about liquidation preference. There is a kind of a related thing called dividend preferences, and that doesn't really factor in very much into private companies, at least early stage private companies. So Laura, maybe if you would like, maybe talk to us about what a liquidation preference really is. John mentioned there was a couple of flavors of it, and then kind of also tell us why no one really cares about dividend preferences as much.
Sure. So both of these are economic terms that you'll find in the charter when you do a preferred stock financing, and they're both based on the original issue price of the preferred shares. So both the liquidation preference and the dividend preference will be tied back to some percentage of the price at which the investors originally bought their shares. Liquidation preference is a really important concept. And what it means is that if you sell the company, the investors get paid back at least their original price per share prior to any proceeds from the sale of the company going to the founders and the other common holders. This is one of the key economic preferences, perhaps the key economic preference that attaches to the preferred stock and why these shares are considered preferred. Note that it's a downside protection. It's an at least the original issue price. It's not an upside cap. So if you're selling the company at a valuation such that after you pay all of the liquidation preferences to the preferred stockholders, there's enough money left in the acquisition consideration that the common stockholders are getting a higher price per share than an applicable series of preferred stock. The preferred stock flips, and instead of getting its floor liquidation preference, the downside protection of the original price per share, instead it participates alongside the common stock and gets that higher price per share that's calculated on the basis of the total amount of proceeds available in the liquidation. We'll go into the difference between participating and non-participating preferred in a second, because that does impact the calculation of how the preferred participates in the liquidation, whether it's just the floor versus flipping into the common, or whether there's something more there. But I want to address your point, Aria, about dividends. So the reason dividend preferences are less relevant for startup companies is that private venture-backed startup companies almost never pay dividends. So you'll have this provision in your charter saying that if you were to pay a dividend to the common stockholders, you have to pay some preferential amount, usually expressed as a small percentage of the original issue price to the preferred stockholders. We almost never see these things come into play in practice. Usually, once the company becomes profitable, the company is reinvesting those proceeds into continuing to grow the business to a potential future exit event. And so, although the dividend preferences are negotiated into every preferred stock charter that we do, they're rarely a practical concern.
Interesting. That's a big distinction, I guess, with the public companies, what people see listed on the NASDAQ or the NYSE, where all these blue chip companies are paying dividends, and that's really important to investors. You're saying in the private context, in the startup, VC-backed startup market, that's not a thing. No, the investors aren't looking for 5% every quarter. Really, what they're looking for is for the company to grow and have that nice astronomical exit at the end. So they don't care about the coupon as much. John, maybe you can maybe walk us quickly through the different flavors of this liquidation preference. In particular, I think the interesting one is non-participating versus participating, because it sounds like everyone participates anyway. So what does that really mean?
Right. Well, from the founder's perspective and the perspective of common stock, a non-participating preferred stock is the best preferred stock that you want to offer your investors. And we will counsel clients not to offer to investors a participating preferred stock. So what a participating preferred stock says is that the investors receive on a sale of the company not only their original investment, as Laura was pointing out, in most cases, the liquidation preference is equal to the original purchase price. So they will not only receive their initial investment back, which can be tens of millions of dollars, but they will also receive their pro rata portion of the remaining proceeds in the company alongside the common stock, as if they had converted into common stock. So it's in some ways sort of a double dip. They get their money back first, and they get their percentage ownership of the remaining proceeds of the company. What that means is that all sale valuations, the preferred is always receiving more per share than the common stock. And that's a key distinction between participating preferred and non-participating preferred, and why we like, and founders also like, non-participating preferred, which says there's a point at which if the company achieves a high enough value for sale of the company, that everyone receives the same price per share. And that's the point at which, as Laura was pointing out earlier, if the preferred stock converted into common stock, they would receive a price per share that is greater than their original purchase price, excluding the original investment made in the company. So the idea is, with non-participating preferred stock, to give them, the preferred investors, downside protection, their original investment, but at a certain conversion point, they can only receive more than their original investment by converting into common and participating. It's a bit confusing to use the word participating in this context, but participating alongside the common stock as common stock to receive any additional proceeds in the company. Okay,
got it. And so that's how liquidation preference are really a downside. That in that scenario, when it's non-participating preferred, that the liquidation preference is truly a downside protection for investor, because it's like, okay, if the company sells and not for a lot, you get your money back. Essentially, nobody else gets any money. And I think that's important for founders to understand, is how that works. But then if it's a good enough sale, if it's a home run, we should all celebrate. And we should all kind of participate based on how many shares we have. So you don't get another dip. You don't get a second kick at the can, whatever your metaphor wants to be. Okay.
Yeah. And just to put some numbers around it, let's suppose investors have invested an aggregate of $25 million in the company, and the company is sold for $35 million. The investors own 50% of the company. In this example, the investors, because they're owning they've invested $25 million in the company, the only way they can get more than, or to receive their $25 million back owning 50% of the company, is to remain preferred stock. Otherwise, if the company is sold for $35 million, they're only going to receive half of $35 million. On the other hand, if the company is sold for $100 million and they've invested $25 million in the company, they want to receive more than $25 million. They own 50% of the company. So the only way that they can receive more than $25 million is to convert into common stock, and therefore they'll receive $50 million out of the $100 million in sale proceeds. This is very different in this example, which I gave, which is a non-participating preferred stock, to a participating preferred stock, in which case, if a company sold for $100 million, the investors will first get $25 million off the top, and then they get 50% of the remaining $75 million in proceeds. And as you can see, 25 million plus half of 75 million is greater than half of 100 million. So this is why non-participating preferred stock is better for founders than a participating preferred stock.
I see. Okay, that clarifies it, and we won't make you do math live here, John, by saying what's half of 75. So we'll
37.5 million. So
there you go. Yeah, so
25.
that is an outsized return. Okay, well, let's move on and talk about the second thing you mentioned earlier, John, which is that lead investors in these preferred stock financings like to take a board seat. Maybe actually give us a quick overview of what a board is, because I think that may not be so clear to a lot of people. And then let us know how it works in terms of the investor getting on the board.
Right. Well, the board is the principal governing body over the company, and the board is responsible, has fiduciary duties of loyalty and fiduciary duties of due care to make sure the company is doing the right thing, and in particular that the CEO is doing the right thing. And I mentioned to many founders that the only way a founder can be removed from the company is through the board. The board has the power to remove the CEO. No other person or body has the right to remove the CEO of the company. So from the founder's perspective, it's incredibly important as well to understand who is on the board, because the board does have the power to replace the founder CEO of the company. Investors will want to have the right to appoint board members. Usually a lead investor in a Series A financing will be on the board. Secondary investors and seed investors, smaller investors will sometimes ask for board observer rights, which is different than a full board seat, which is the right to participate in board meetings, but not to vote, the right to receive information about the company. But the lead investor will want the right to influence the direction of the company through the voting board seat. And in most cases in Series A financings, we see an investor having one board seat and the founders having two board seats. In this case, the founders will maintain majority control of the board. Sometimes investors will also require that the company put in place provisions for independent board seats, which might be the fourth board seat and the fifth board seat. And there's negotiation as to who appoints the independent board seats. Many times we will want the founder to have the right to designate who those independent board seats are, subject to the approval of the investors, or the investors may negotiate that those independent seats need to be approved by a majority of the board, or approved by everyone, the founder and the preferred director. So there's a variety of different ways in which the independent board seats can be appointed. But in most cases in a Series A financing, we see only 3 or 4 board seats, 2 founders and 1 preferred.
I can jump in and add that, all of these concepts relate to control and who has control over the company long term. And working with all founders, but especially early stage founders, I know folks get really concerned about control and how to maintain control of the company long term. And so there's a couple of different things and concepts that we're talking about when we talk about control. One is stockholder control, and the concept of veto rights, which we'll talk about in a minute, plays into which stockholders have control over which actions by the company. And the other is board control. And so one thing we often counsel founders at the early formation stages is you need to think about these as separate axes of control. You may lose control of the majority of the stock of your company over time. One thing it's important to remember as a founder is dilution is a fact of life. If you maintain control of a majority of the stock in your company long term, that probably means you failed to raise money. And so the company's not doing so well. And one of the ways that we offset the loss of control of the stockholder vote as you take dilution over the life cycle of the company is trying to build board structures that help to make sure that founders retain control over certain key actions that matter to the founders. And so remember that dilution is a fact of life. There are ways to offset some of the control that you'll lose through dilutive issuances of stock in your company via putting in place different board structures. And so these types of topics are really thought about in tandem and negotiated sometimes very heavily as a package when you do a preferred stock financing.
Yeah, that's a very helpful perspective, I think, to relay here. And just from my own experience, I would say this is where it really matters who exactly is the venture partner at like the venture company that the founders are talking to, because that person is going to be on the board, involved in every major decision the company makes. So this is where we talked about this a little bit in the last part of this episode, but this is where it's really important to know that who that person is, and make sure they're going to be a good partner to the founders, because whether it's a long-term or short-term, how many years, they're going to basically be running this business as partners after that person gets on the board. So Laura, you mentioned these two axes. Let's talk about the other axes, which is kind of stock holder control. In particular, let's talk about the negative controls that you mentioned are a key part of the preferences attached to these preferred stock in terms of protective provisions. Maybe explain what that means, negative control. What is a protective provision as opposed to, I don't know, an offensive provision, and what are some typical categories of these that we see?
So the protective provisions, there'll be a section in your charter following a preferred stock financing literally called protective provisions. And what we mean by negative control is veto rights. They're a series of thou shalt not type events where you need to obtain the consent of a majority of your preferred stockholders in order to obtain these actions. Now, they really do tend to pertain to, there's a set list of protective provisions that we see in most preferred stock financings, and they really do pertain to sort of key events in the company life cycle. So veto rights for the investors over a sale or liquidation of the company is one that we usually see that as a typical and standard protective provision to include. Another one I get asked about a lot, especially by early stage founders, is will my investors have a veto right when I go to raise my next round of financing? And the answer is generally yes. One of the protective provisions that we usually see is any amendment and restatement of the charter itself, which is required to create a new series of preferred stock, and also any creation or issuance of a series of preferred stock that has equivalent or greater rights to the existing preferred stock. Both of those events tend to require, in most cases, the consent of a majority of your existing preferred holders. So the answer is yes. Generally, the preferred stockholders as a group, the majority of the shares of outstanding preferred stock will have a veto right when you go to raise your next round of financing. And that's one of those standard provisions that's in the vast majority of funded company charters. And so it's just a question of understanding what those rights are when they kick in, and what are the investors at the table? Which of your investors do you need to get to that majority consent threshold? We'll see some other rights in there pretty regularly, such as changes to the board of directors composition, incurrence of debt by the company, issuance of any dividend or repurchase of any stock. And then if you're a token company or a company in the token or the crypto space, oftentimes issuance of any tokens or token rights or related type concepts will also come into the protective provisions.
And I would add, from the founder's perspective and the perspective of common stock, generally, we like to see that these protective provisions or veto rights are elected by a majority of the preferred stock as a class. So it's important in terms of the term sheet and negotiating the term sheet to specify all of these rights, because they are highly negotiated, to be specific in the term sheet about them, as well as what is the voting threshold that's required with regard to these rights. So to the extent a founder can keep it at a majority of preferred stock as a class, that's the best outcome. One of the issues, if the voting rights become series-based rights, is that as the company does subsequent rounds of financing, Series B, Series C, Series D, if you set the precedent now at the time of Series A that you're giving investors a series vote on these rights, and it's very likely that future investors will also ask for a series vote. And one example of why this can become a problem is on a sale of the company. So for example, a Series C investor who's paying a higher price per share, but who may hold a smaller percentage of the company than an earlier investor, if that Series C investor has a series vote on sale of the company, then they will essentially have veto right over sale of the company. Whereas if the company had maintained the precedent of a class-based vote, then a majority of preferred stock as a class is all that's required to sell the company. So it has economic implications down the road. We also see as another variant and probably a better outcome than granting investors series votes down the road who are negotiating for series votes is to go with a super majority type threshold. So rather than 50% as the threshold that's required for preferred stock consent, to go with a higher percentage, like 2/3 of the preferred stock as a class. Sometimes that's a better way to keep this voting mechanism as democratic as possible and not grant veto rights unnecessarily to future investors down the road.
Yes. Yeah. And I think all three of us have seen these become issues. So like you said, John, I think it's very important to be specific and understand what everyone is agreeing to here. So if I may summarize the protective provisions, it sounds like essentially they are a way for stockholders to stop the company from doing something that might change the bargain that they have struck at the time that the investment was made. So it's either changing the economics of their investment by, for example, putting more senior preferred stock on top of them or debt, or changing some of the control rights that they had negotiated, for example, by changing board composition. Or, essentially the sale of the company, I guess, is the biggest way you can affect someone's economics. So that usually, like you said, both becomes a negotiating point. So let's move on to another point that relates to the economics of the investment that is usually in there, and that is anti-dilution protections. And John, since you were giving us your thoughts last, why don't we ask you for your thoughts on this as well to start. What are these anti-dilution protections? I thought Laura said dilution is a fact of life. So what's this?
So dilution is a fact of life in terms of selling a percentage ownership of the company to investors. And investors will also ask for a price-based anti-dilution protection, which means if the company in a subsequent round of financing sells its preferred stock at a price per share less than this round of financing, they want some price protection. So the most sort of protective form of anti-dilution protection for investors is full ratchet anti-dilution protection. And for example, if the company sold Series A preferred stock at $10 a share in the Series A, and then sold Series A preferred stock at Series B preferred stock rather at $5 a share, half the price, then the full ratchet would give investors twice as many shares, full price protection. And the way that's implemented in all of these anti-dilution protections is through the conversion ratio. So in the full ratchet case, the investors would receive 2 shares of common stock on conversion of their preferred, as opposed to 1 share of common on conversion of their 1 share preferred. We almost never see full ratchet protection and strongly advise founders not to negotiate full ratchet protection to investors. The form that is most common is the price-based weighted average anti-dilution protection. And this is a weighted average formula because it takes into account the number of shares that are sold in the Series B financing and the percentage discount to the Series A price. And it results in significantly less anti-dilution protection to the Series A investors than the full ratchet example. And I mentioned the full ratchet example as the first example to put the price-based weighted average protection into perspective. We also recommend for companies that are early stage, if possible, not to have any anti-dilution protection, because as a company is growing, the Series A investors should really view their position in the company as being more akin and having their interests more aligned to the interest of founders, because they're paying the lowest price, we hope, per share of any investor in the company. It's from then going forward that the Series B, C, and D will be paying a higher price per share. So if possible, try to avoid any anti-dilution protection at all. Laura, I think you might want to mention some of the exclusions to anti-dilution protection?
Yeah, happy to do so. Anti-dilution is a complicated concept, right? It's really hard for founders to understand it in depth, and it's hard for a lot of lawyers to understand in depth. Honestly, it's a concept that we work with for a lot of years before it really starts to make sense. And so, if this whole section is a bit confusing to you, that's totally fine and normal, and you can work with counsel to explain this in real time as you're negotiating these provisions in your charter. But one area to really focus on is the carve-outs to the anti-dilution protection. So the way that anti-dilution is structured under the charter is really super broad. It says anytime you issue any share of stock whatsoever to any purpose to any person for any reason, if that person pays less than we the investors paid for our stock, including a stock price of 0, then we're going to get this adjustment under the charter. And so obviously that's more broad than the anti-dilution protections are really intended to capture. They're intended to capture doing a down round, as John referred to a minute ago. And there are lots of issuances of stock in the sort of ordinary day-to-day operation of the business. For example, giving stock or stock options to your employees as equity compensation. You might be giving those stock or stock options out at a very low price or a price approaching 0. And you don't want to have an adjustment event for your investors every time you do something like that. So the carve-outs to the anti-dilution protections are super important in terms of these are the times in the ordinary course of operating the business that we expect to be giving out stock at a cash price that's less than the price the investors paid. And we don't have to come back and get a waiver or adjustment to the investor's conversion price every time we do this. So, issuance of equity to employees is a really standard and common one. There's other commercial issuances that we think about and will often negotiate into a charter. For example, if you're giving warrants to a commercial partner in connection with a commercial relationship, or if you're taking out venture debt and you're giving warrants to your venture debt lender in connection with that relationship, if you're acquiring a business or entering into a JV with a business and you're giving equity consideration as part of that acquisition event down the road, these are the types of things that we see under the anti-dilution carve-outs because, it's not really reasonable. It's not part of the bargain to expect that the investors would get a anti-dilution adjustment for those types of issuances. It's not really a new fundraising. It's not really a down round. And so paying close attention to the scope of what those normal equity issuances that are carved out of the anti-dilution provisions includes is important. It's something to work on with your lawyer and to just pay attention to, because those are the items where you don't have to come back to your stockholders for a waiver.
As with the protective provisions or the veto rights, we also recommend in term sheets that we spell out what those anti-dilution exclusions are, because those tend to be an area of significant negotiation.
That's right. And Laura, John mentioned that the way these anti-dilution protections actually work is by adjusting how many shares of common stock the preferred stock convert into. So which is some one of those interesting ways that these rights and provisions all work. It's not like the investors actually get additional shares issued to them in a lot of cases, but it's kind of adjusts their economics for when the company is sold. So let's talk about how this conversion works. John mentioned also, I think, at the beginning of this episode that that there's these automatic conversion events that happen. So, for example, on IPO, everyone converts into common stock. Laura, maybe you can take us through those, the kind of difference between optional and automatic conversion and what that all means, really.
Sure. Both of these concepts around automatic conversion really relate to exit events, right? There's the IPO, and then there's the other big exit avenue, which is a sale of the company. And so when you go public on the NASDAQ or the NYSE or any listed exchange, there are very few, there's a couple, but there are very few public companies that have multiple classes of stock outstanding, right? Generally, one of the things that happens in the run-up to an IPO is you do what we call flattening the capitalization stack, which means all of these preferred stock classes that are outstanding in the run-up will automatically convert down into common stock, so that as of the moment of listing, when you do an IPO, you have a cap table that's 100% common stock. Similarly, under certain circumstances, if you're selling the company to a third-party acquirer, the structure of the acquisition for tax or other reasons might require that the capitalization stack get flattened prior to entering into and consummating that acquisition. And so you might have other circumstances, again, around an exit event, even if it's a great exit, knock it out of the park, upside exit, where one of the conditions or requirements legally in order to get that exit over the finish line is to convert all of those series of preferred stock down into common. And so this is something we build into the charter when we negotiate the preferred stock financing round. There are kind of two alternative triggers to convert all of the preferred stock down into common in connection with an exit. One is this concept of a qualified IPO. So if you do an IPO, there'll be certain sort of parameters around which you will be able to convert all of your preferred stock down into common without going back to the preferred stockholders for any waiver, consent, or otherwise. Usually, the kind of key parameters to focus on here are thresholds. Sometimes there's a threshold related to the total amount of proceeds received by the company in the IPO. We usually see that one in the charter. We'll also sometimes see a threshold related to the price per share in the IPO. For example, that the price per share of the IPO has to be something like 2x or 3x the original issue price of the most recent series of preferred stock. From a founder perspective, the less thresholds that are included in this automatic conversion scenario, the easier it is to get over the finish line with an IPO, right? You might have an IPO that is going to raise a ton of money for the company and be a really great event for the vast majority of your stockholders, but it's only at 2x the most recent share price and not 3x. And so if you can limit the IPO conversion trigger to an aggregate proceeds amount rather than a price per share threshold in addition to the aggregate proceeds amount, it gives you more flexibility with a greater range of IPO exit scenarios to be able to affect that automatic conversion without having to go back to the last series of preferred, for a vote. As John mentioned earlier, sometimes the latest series of preferred, it's going to be the most expensive series, right? So it might be in a slightly different position economically from the other series of preferred, and any special veto rights that you give that series could potentially lead to friction in the event of an exit down the road. So that's one scenario, is the IPO, where the common stock will automatically convert into preferred so long as you meet certain thresholds. The other scenario is kind of a catch-all, right? You don't know exactly at the moment that you're doing your preferred stock financing. We as lawyers don't even know what are the circumstances under which an exit might require all of your preferred to convert into common. We can think of a few, but people are coming up with new and creative acquisition structures every day. And so the way that we structure around that is to set a prong where some percentage of the preferred stock can vote to convert all outstanding preferred shares down into common. And again, the idea of this is if you have a proposed exit that requires a conversion of preferred to common, but you have enough preferred stockholders around the table that reach that threshold percentage that are interested and willing to go for the exit, you can then get the vote of those folks to convert the preferred stock down into common. John, a lot of the same voting dynamics apply to this, voluntary preferred conversion question that apply to the veto rights in terms of setting the threshold and series votes. Do you want to walk through those again?
Yeah, this is an important point because, as Laura pointed out, when you convert preferred to common, what happens is all the rights of the preferred disappear. The preferred stock becomes common. The most important right for most investors is their liquidation preference. So later stage investors are particularly focused on this point because they many times will want to ensure that they have veto right over the ability of earlier investors who've paid a lower price per share to convert all preferred stock, including their preferred stock, into common stock and wipe away the liquidation preference. So this is an area that we see later stage investors in particular asking for a separate series vote on conversion outside of an IPO into common stock.
Yeah, all great points. And John, I think as you mentioned, it's really important to kind of get specific about all these rights that we just talked about at the term sheet stage. And Laura, I think you would agree, because that's where companies actually have the most leverage, is at the term sheet stage, especially if there are different investors hopefully vying to lead the round. That's where you can make sure that you get the most company-friendly terms possible before the deal starts happening. After the term sheet is signed, while a lot of these rights are not actually binding on the parties, it's generally considered very, very bad to deviate from the agreed upon terms in the term sheet. So it's important for both sides really, but for companies especially, to have good counsel and that can advise them as to what all these interplay of all these rights, how they all work out and what these rights mean and how they're going to affect them in the practical day-to-day trying to build this company and really scaling it. So I think we can maybe leave this discussion here, and then in the next part, like I mentioned at the beginning, we will talk about some more rights that are personal to the investor as opposed to attaching to the preferred stock themselves. Difference being the rights attached to preferred stock, if the stock is transferred, they go with the stock, so the new holder kind of gets those rights, whereas the rights that are personal to investors going to stay with the investor. They can't always be assigned if the investor sells their shares. So there are some really important rights there in that bucket as well. So Laura, John, I hope you can come back and we can talk about that soon, because I think that's the final piece of how this all works together in an early stage financing transaction. So thank you both for your time. Really appreciate it. And we look forward to having you back on the show.
That sounds great. Thanks, Aria. Thanks, Laura. Looking forward to the next episode.
Absolutely. Thanks, guys.
Thanks, everyone.